Hi everybody. I want to work on CashKing's sales and collection budgets. We have a couple of policies or assumptions here that the clients have given us. Of the total sales, 20% will be in cash. So what are the remaining 80% going to be? On credit or on account. They go into accounts receivable because we did the thing, either shipped them the product or did the service, so we are entitled to receive payment, but the payment will be delayed because we've allowed them sales terms. Well, when are we going to get that? Well, they tell us here that of the credit sales, 25% will be collected in the month you made the sale, okay, and the remaining amounts, the remaining 73%, are going to come in a month after the sale. And 2% are never collected. That's your bad debts. Of course, they'll try to collect all of it, but they know from their history, apparently, that this is the assumption they want to use in their budget. What is the accounts receivable on December 31st of year 3? We're doing year 4's budget, January through April. So what is year 3 accounts receivable? That's the sales revenue that's been earned in December that wasn't collected in December because it's going to come the month after the sale. So December sales that weren't collected in December would be credit sales collected the month after the sale. So they're coming in January. So as of the end of December, they're still owed. They sit in accounts receivable until they're finally collected in the following month, or at least as much as they expect to collect. Great, so let's give this a try. So here they give us the budgeted units and the sales price they expect. And so the sales revenue budget is the units that's projected times the sales price. There's total sales revenue. That's what you earned. You did the thing for the customer. They owe that to you. 20% of that, they're going to pay you right there on the spot when you do it. So 20% for each of the months. The rest is a credit sale. So of the $18,000, subtract the cash sales and you get the credit sales. Or you could do the $18,000 times 80%, the remainder of the 100% of sales. Either one is fine. They'll give you the same math. So that's our sales budget. What about our collections budget? So in our collection budget, we're going to be mapping out the collections we expect based on the assumption the client gave us. So we already know that the cash sales come in the month that they're sold because we get the payment right when we sell it. There's no delay. We know that we're going to collect the rest of December. Okay, so they budgeted. Now, what about January's credit sales? Not January's total sales, because some of it was already collected right away, and we have that in here in our collections. But what about the credit sales? So the credit sales are the 14.4. How much of that's coming in January? 25%. When's the rest coming in? Well, we're not getting all of the rest of the 14.4, but we're going to get 73% of the 14.4 in February. And that's those two added together are not exactly the 14.4. Why not? They're a little bit short of the 14.4 because 2% are never collected. That's what they're budgeting for bad debt expense. Okay, let's do February. So February's credit sales, we already have cash sales in there, will be 25% sold in February, collected in February. And then the rest of February's credit sales that we expect to collect is coming in March, and that's the 73%. And so if you add these two together, it's a little bit less than $15,840. That's what you would expect. If you want to make sure, do a little double check that you haven't done some weird math thing. If you add these two together and they're bigger than 15,840, you have a math situation. So what about March? We already have cash sales in here, but what about the credit sales? It's going to be split between March and April. How much of it's coming in March? The 25%. How much of that 16,800 is coming in April? The 73%. And those two numbers added up are going to be a little bit short of the 16,800. They should be 2% short for the uncollectible accounts that they're estimating in the budget. What about April sales, credit sales? We already have the cash sales in here. So of the 13,440, how much is coming in April? 25%. So what about the rest of April? When are we going to get that? We're going to get that in May. So it's going to be in accounts receivable at the end of April. It's not collected yet. We did the thing. We recorded the revenue. That's credit sales that haven't been collected yet. So that 13.4 times what we expect, because this is a budget, not a financial statement. In the financial statement, you would put the whole amount until you wrote it off. So that's from your prior accounting class. You record all of the unpaid invoices in accounts receivable, and then you have a bad debt policy to decide at what point you record the bad debt expense, at what point you write off an uncollectible bill, which is usually many months after the sales, not immediately. In a budget, you put in your plan, your expectations, so that you have realistic expectations about how much cash is coming in. So here we want to put in what we expect to collect in May in the budget. And so here we expect to collect 73%. So the only thing left here is just do the math and add up the months to get the expected receipts. There you go. Let me know if you have questions.